Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, welcome back to another episode of the ASB Investment Podcast. I'm your host, Nigel Grant, and today we're doing a bit of a special follow-up discussion off the back of our latest ASB Investor Insights webinar or client call we had the other day. We just wanted to check back in with clients after the volatility period that we've had. And this one, which this podcast is very much like the call we had with clients, was about picking up questions that are specifically on their minds, that were the key things that we think we needed to get answers back to them on. So we wanted to bring you a similar call a couple of weeks later that picked out the key questions they were asking us that we thought were, you needed to know about. And so to help me here today, I'm joined by someone who was part of that webinar, seminar, call, whatever you call it with me, Mr. Will Porter from BlackRock. Will, it's good to see you again. Is it all well with you over there in Sydney?
All is well with me, Nigel, and thanks again for having me. This is a far more intimate setting, though. Usually there's me and you and maybe John Smith or David Griffith from BlackRock. But so, I'm happy to be here and happy to talk about kind of what we're seeing in markets and how the ASB portfolios are positioned in the face of that.
So for those new to the podcast, you've been here before, but can you please give us a brief intro on what you do for BlackRock in terms of your role and for also us here at ASB?
Yeah, certainly. So my title is I'm an investment strategist here at BlackRock. And so I suppose what that means for ASB is that from an investment perspective, myself and the team that works with ASB are really here to deliver kind of the best of BlackRock investment insights to the ASB portfolios. And that kind of looks like strategic asset allocation and how the portfolios are constructed on a strategic basis, but also kind of bringing shorter term minor adjustments to portfolios into the mix as well. But then we've got a broader involvement as well. We're talking to the ASB investment team regularly on portfolios and how they're constructed, and then also regular engagement with the advisors over at ASB as well. So very much a partnership between the two of us.
And I like how we've the relationship Will and I have started to bond on is who can wear the best tie and who can outdress each other. So I think I always enjoy a little back and forth on that. So first up, before we get into kind of the questions we've received, I thought it was important to quickly hear for you to hear from Will on the very latest thinking, how we're managing money and thinking about things in the context of the portfolios and what's been going on. So Will, how have things been performing since the last call, considering what a wild April it has been?
Yeah, look, maybe I'll pick up on kind of that wild April that it's been.
Yeah.
And look, been a pretty volatile start to 2025 more broadly. April was probably the pinnacle of that. We saw a lot of commentary around the imposition of tariffs and how that might look. And I suppose the big piece on that tariff or the impact that the tariffs had was that markets were generally looking for sort of a 10% US average tariff rate. And what we were delivered on Liberation Day, as it's been called, was a number that was more like 20 to 25% average effective tariff rate going into the US. That's a level we haven't seen for sort of more than 100 years, and definitely disappointed the market. And we saw some reasonably volatile action there across most asset classes. To maybe provide some economic context to the imposition of those tariffs. So the US Congressional Budget Office and the Peterson Institute did some work around what a 10% tariff might look like from an economic growth impact as well as an inflation impact. And at that sort of 10% level, they were thinking that it'd be, GDP maybe 1 to 1.5% lower in the US, and prices maybe up about 0.6 to 1.2%. So inflation up 0.6 to 1.2%. And obviously that was at a 10% tariff rate. What was delivered was more 20 to 25%, so meaningfully higher than that. And I suppose that caught markets off guard a little bit. Subsequent to that, we have seen, a little bit of a de-escalation in terms of those trade discussions. We had the 90-day delay to those reciprocal tariffs that were in place. That's due to expire on the 8th of July. Maybe the exception there was China, where sort of ongoing tariff imposts were put in place and tensions continue to kind of brew. But we have seen, in the last week or so, maybe some of that de-escalating as well, with China suggesting, there's no harm in engaging in trade talks with the US. So maybe a step in the right direction, at least as it pertains to that relationship. If we think about markets, if you look at April from start to finish, and assuming you hadn't read a newspaper and you hadn't heard any of the announcements that had been made, the end outcome was almost like a bit of a blink and you'll miss it kind of month. So start to finish, S&P 500 was kind of up marginally, and bonds kind of offered some reasonably positive returns. And that kind of masked a little bit of kind of the volatility that we saw. And I think a lot of the recovery came from that 90-day postponement in terms of those reciprocal tariffs. There's obviously still a fair bit of uncertainty kind of emanating from these trade negotiations and how they'll play out. And I suppose the point that I've spoken to on these webinars, and I think that's resonated pretty well and an easy way to kind of remember what to look out for, is these 3 R's that we talk to. The 3 R's that we're looking at is one, the race to the landing zone. So that refers to kind of what is the end US average effective tariff rate that we get to. So 20 to 25%, is kind of where we're at. We expect that's probably going to come down a little bit, but to what extent kind of remains to be seen. The second point, or the second R, is retaliation. How do other countries respond? And I suppose that's a little bit on hold as well while we're in this kind of 90-day reprieve. And then finally, the response from companies. So we're actually in a period at the moment where US corporates, US companies are reporting earnings. So we're getting a little bit of an insight there into kind of what they're thinking about as it pertains to kind of trade difficulties or otherwise, and whether or not there's kind of, more motivating factors to kind of change supply chains or provide, variations of forward-looking guidance. A great example of that was United Airlines, I think, came out. They gave 2 sets of guidance, one for a kind of more normal market environment and the other for a recession environment, which is kind of an extreme case. But, it has to be given some credibility in the face of kind of, those tariffs at 20 to 25%.
I guess our first question that we received, improvement for that client call was, in April, as you've said, I noticed there were a lot of this hasn't happened since X year, like a lot of, unprecedented things, or, they haven't happened for a long time, but the question we got was, what are the, this is what's happening, but what are the likely investment implications of this unrest? What do you guys' view on that?
Yeah, look, and I think, as I alluded to earlier, the market view was kind of broadly in line with those US Congressional Budget Office forecasts around the impact of tariffs, and even that tariff level being around 10%. And that's, the outcome really there is that growth is impacted in the US and inflation is maybe a little bit higher than what it would be without these tariffs. So maybe we dig into those 2 sides of the equation, explain kind of how that manifests itself or what draws that out. So on the growth side, really this stems from kind of business and consumer confidence. And we've already seen a deterioration in those measures out of the US in particular. And, this is understandable. If we think about this from a business perspective, you now have this trade environment where you need to consider how and where you source your inputs. And if those costs have changed meaningfully, there's a potential that you might need to consider your supply chain and where you source your kind of inputs from. This could take away sort of attention from other kind of more growthy capital expenditure plans. And again, you kind of refocus back on sort of solving these issues that have kind of crept up. And we actually saw some evidence of this in the corporate response. If we look at kind of the Q1 GDP numbers, there was a negative number there. But largely that was kind of attributed to this front running of stocking. So a huge number of imports that came through in that first quarter GDP read. And that brought down kind of the GDP growth number there. And then similarly, you think about that from a consumer perspective, it's very similar kind of response, I suppose. You're unsure what these tariffs mean for you from a kind of cost of living perspective. Maybe you've put some you halt some plans that you might have for kind of large scale purchases like homes and the like. So all of these things kind of create, a bit of indecision, and that kind of slows down economic activity a little bit. And that's kind of the impact on a growth side. And then if we dig into maybe the inflation side, there's probably two impacts. The first really is the direct impact from tariffs. So you have an immediate price increase. If you're a business and say it costs you $1 for you to import something and that now costs you $1.20, to protect your margin, you increase your prices by that 20 cents as well to cover the additional cost. And that's the potential direct impact. That's kind of what we would see in sort of CPI prints potentially. But I suppose the uncertainty and how long that uncertainty persists for, and then the ultimate tariff rate could have greater implications. So here we're talking about, if corporates need to rewire their supply chains, that requires a huge amount of investment during a time where everything is a little bit supply constrained. And these are things that we've talked about previously on podcasts here. Be that labor. So labor markets generally a little bit more supply constrained as we see kind of demographic shifts and shrinking workforces in a number of countries. And then from an input perspective, not only do we have tariffs and what they impose, but also you kind of look at the geopolitical tensions that we're seeing more globally, and that's kind of putting supply constraints on sort of commodity inputs and the like. So ultimately, those kind of supply chain rewiring pieces need to be passed through to end consumers. And that takes a little bit longer, and that's where you kind of see maybe a bit more of a persistent inflation driver.
The stockpiling of inventories has given me flashbacks to when we all went out and stockpiled toilet paper during COVID, and we all needed 200 rolls apparently just because we just needed to get it. But I guess you mentioned, the sort of you blink and you might have missed April, or if you went, you didn't follow it, nothing much happened when you look on the numbers. But, have markets recovered, or, what will it take for markets to recover if they haven't fully already?
Certainly when we look at equity markets, they're now back to those kind of pre-Liberation Day numbers, especially in the US, maybe seeing a little bit more pressure in some emerging market economies. But generally, we're back up to kind of levels that were that pre-Liberation Day number. I suppose to see a further leg up in kind of returns from here to kind of get us back to end of 2024, we really need a bit more of a removal of the uncertainty that's coming along with all these trade negotiations. You think about this uncertainty from an end Kiwi saver perspective, that may represent itself as kind of like a feeling of, less conviction in what your end retirement outcome might be, or your ability to fund your first home, whatever it might be. And all of these uncertainties makes people question existing positions and maybe rethink where they need to be set. Now, often that's not the best time to do that sort of questioning, but psychologically you can understand kind of how people land at that point. But again, as I reinforced, kind of we've got the S&P 500 back up to those levels that we had pre-Liberation Day. And as we see more details emerge around the structure of trade deals or trade negotiations, and as we see more details around the corporate response in the face of these trade negotiations, that uncertainty again kind of dissipates a little bit further, and markets can refocus their attention back on away from the noise of headlines and things, and refocus back on fundamentals that are generally the longer term driver of portfolio outcomes. Sure. And these are things like economic conditions, corporate health, leverage, all of these sorts of long-term things that we all think about. And that's kind of where we think, the next leg might come from, a little bit more clarity.
The third question we had, I guess it's all related to the item du jour through April was, these tariffs themselves. The question we got was, why did this particular announcement or, announcements like these, why do they have such large influence on world markets? Is it simply because we were surprised by them?
Yeah, look, I think, as I mentioned earlier, tariffs themselves were not a surprise. Markets kind of had an assumption that these were coming. The Trump administration in their first term did use tariffs as kind of a trade negotiation tool. And then in the lead up or during the campaign for President Trump, leading into the election and his appointment, there was heavy reference to the use of tariffs as a negotiating and trade equalization tool. I suppose the real surprise was the extent of that tariff imposition, and that caught everyone a little bit by surprise, I suppose. And again, that size piece is really the driver. A 10% tariff had kind of broadly been digested by corporates and markets. And as we said, those forecasts had been provided by the US Congressional Budget Office, all based off 10%. So there were some adjustments that were required, and that economic impact given consideration around a much higher rate of tariffs and the longer term impacts of kind of a higher tariff rate environment were needed to be digested by the market. Specifically kind of those ongoing questions around whether or not supply chains need to be, again, a little bit more rewired in the face of that.
So flipping this around a bit as well, like, there's obviously the initial sell-off we experienced and, what on earth is going on. But, flipping it around, looking at, I guess I'm keen to know, are there opportunities out there presented by announcements like this, whether that's now or eventually, So the question we got was, is it possible that NZ or, if you don't have a comment on NZ, other countries could benefit in some way, from these announcements? Are they better off?
Yeah, look, it's an interesting question, Nigel. And like everything I've spoken to previously around kind of the economic impacts have probably been very US centric. And that's, appropriate given that that's where these kind of trade decisions have been kind of emanating from. But it's possible that perhaps these tariffs are maybe a little bit deflationary for other economies. And I'd put New Zealand perhaps in that category as a possibility. And I suppose the question there is, how's that the case? New Zealand is also getting a tariff imposed on them. Mm-hmm. So let's kind of run that through. Assuming we have this ongoing very high tariff on goods in China, as an example. That's Chinese goods going into the US specifically. Those prices of those Chinese goods would likely increase significantly for the US consumer. Mm-hmm. So Economics 101 tells us that when prices increase,
demand goes down.
That's right, demand reduces. And if there is less US demand for Chinese goods, there will ultimately be a supply side response from China. There's no doubt in that, i.e., they maybe produce a little bit less. But in the interim, there's this kind of excess supply that needs to find a home. And perhaps an economy like New Zealand might be a beneficiary of that kind of excess supply of goods that kind of fills the void of goods that might have been headed for the US. They could perhaps end up in New Zealand. And that's kind of one example of where we might see some deflationary impact. Maybe just caveat that a little bit also, because the relative tariff position of New Zealand in that kind of board of tariffs that Donald Trump or President Trump presented was much lower than what we see in other nations. So it was at 10%. But I suppose the secondary impacts on key trading partners of New Zealand probably need to be watched reasonably closely. And, those longer term impacts of those kind of secondary or trading partners is probably really notable for New Zealand. China being the key one there. Other key partners like Japan, Korea and Australia pleasingly look like they're at the top of kind of the list of negotiations. They've been mentioned by Scott Bessent in his talks around where trade negotiations are up to, and that's a positive. But China, again, it's a huge export destination for New Zealand goods. About 25% of New Zealand goods end up in China. So the ultimate economic impact to China from the imposition of tariffs probably needs to be monitored reasonably carefully.
So along with understanding kind of what's gone on and what impact tariffs could have and stuff, we got a few questions from clients on, which I think are always the ones that are probably in the back of their mind. What does it mean for me? So the first question in this kind of subsection, Will, was, are there any safe short-term investment options, for moments like this? Does such a thing exist, or are all investments ultimately have a degree of risk?
Yeah, look, I think defining safe is important in this context, and maybe I'll expand on that. Like, you could definitely take lower risk and produce a short-term investment return with lower volatility and not be exposed to these things. But whether those returns will ultimately outpace inflation over the long term, that's kind of the key question. And that's definitely worthwhile consideration for kind of underlying investments. And Nigel, I think we spoke about this reasonably thoroughly on that webinar. And I think you covered this really well. And that was about, there's always risks present in investing. It's just a case of whether investors take that now. For instance, recent market volatility, and versus much later, i.e. the risk of running out of funds in retirement or not having enough income to retain your lifestyle. And that was the point you made, Nigel. I thought you made that really well.
Oh, good.
And I suppose that's the trade-off a little bit there. I suppose just to caveat all of this, I'm not an advisor.
Of course.
But I would certainly recommend for those investors that are feeling uncomfortable, they should have that conversation with their advisor and try to focus on your long-term objectives and, what the ultimate risk is required for you to achieve your end investment goals. And that's kind of the key point there, I think.
What are some of the things, and again, this is another question verbatim that we received, what are some of the things either we don't have in the portfolios, if you want to go there, or that we've recently underweighted, or what have we done recently with the portfolios that you've helped navigate or steward our investors' money through this period?
Yeah, certainly. So, look, maybe there's two things I can talk to here.
Yeah.
One, kind of on the strategic asset allocation and how that is positioned, and then maybe I'll cover off a few things that we've done in what we call risk mitigation, and maybe I'll put a little bit of context around all of that. And I'm going to talk here a little bit about underweights and overweights, and maybe it's worthwhile kind of clarifying what we're underweight to and overweight to.
Sure. Yeah.
And I suppose that's a reference benchmark. And what we consider the reference benchmark it's a mix of assets for each risk profile that's expected to achieve the investment objective over the very, very, very long term. Our strategic asset allocation is a different mix of assets, very similar, but a slight different mix of assets that we think will produce a better investment return over a 3 to 5 year time frame. So just a shorter time frame. So all the comments that I'm going to make here about overweights and underweights are really in reference of how that strategic asset allocation is positioned relative to what we call a reference benchmark.
Yeah, that's what our clients are invested in. That strategic.
Is the strategic asset allocation.
Yeah, just so everyone knows.
Exactly right.
Yeah, you got it.
Yeah. Again, I'll kind of split the portfolios in two ways. One is kind of the growth side of the portfolio, and the other is the defensive side. So when we think about growth, we're generally a little underweight Australasian equities and global equities in favor of kind of more nuanced asset classes like emerging markets and global listed infrastructure. And again, in general, when we set the strategic asset allocation last year, our assessment of expected returns for the more traditional equity markets like Australasia and global equity markets had been a little bit lower than kind of historically has been the case. And that meant that we favoured these more nuanced asset classes like global listed infrastructure and emerging markets. And then on the defensive side of the portfolio, the big picture here is that we're generally quite granular in the way that the portfolio or the income side of the portfolio is constructed. And that's a little bit underweight nominal government bonds and global corporate bonds in favour of inflation-linked government bonds and New Zealand corporate bonds and gold. Now, it's probably important to kind of draw a distinction between what's a nominal government bond and what's an inflation-linked bond.
You got it.
Yeah, perfect. So a nominal government bond is purely the government issues some money. Me as an investor, I lend that money back to the government. They pay me some income over time and then pay me back the amount that I lent them. The difference with an inflation-linked bond is the amount that I've lent them, that commitment increases with the level of inflation through the holding period of that. So it has this embedded inflation protection in it, which we are quite attracted to in this kind of environment of sort of a higher inflation environment than what markets may be expecting. When we think about New Zealand corporate bonds, generally they're a little bit less rate sensitive than global corporate bonds, and that's a feature of them that we like quite a lot. And gold is an inclusion in portfolios really for its diversification benefit. I mean, it has performed incredibly well from a return perspective, but the way that we consider its addition is really its ability to kind of behave very differently to the other assets that are held in that portfolio, and that has proven its worth in a few of the more volatile periods that we've had more recently.
And in terms of the tactical, if I call it tactical stuff, or some of the things you've been just on a short-term basis doing?
Yeah, certainly. So we refer to this as risk mitigation. It's not necessarily kind of tactical trading.
Sure.
We've got a very risk-based approach to the way that we kind of consider the portfolios. And when those risks change or something occurs in markets that kind of makes that our expectation of risk look a little bit different, we respond appropriately. And in this case, more recently, we've done two things. One was on the FX side. So our portfolios are generally a little bit more exposed to foreign currency than the reference benchmark. And that means that we own assets offshore. We tend to kind of have some exposure to movements in the foreign exchange rate. We implemented a structure here which reduced our sensitivity a little bit to movements in that foreign exchange rate.
Right.
And that was at a time when the New Zealand dollar had fallen pretty aggressively in the sort of heat of the post-Liberation Day kind of sell-off. And that's provided some protection as we've seen the New Zealand dollar kind of recover pretty strongly off those lows. Then when we think about the other side of this more recently, so when markets had really had that more aggressive sell-off, it was probably too difficult or too expensive is probably the right way to put it, for us to put in place any protection on the equity side of portfolios. What we've seen more recently is a really strong recovery in equity markets. I think the US had a 9-day consecutive winning streak, which is kind of hadn't been seen since November 2004. So a very strong recovery. And that has kind of made this ability to put some protection in portfolios on the equity side a little bit more palatable from a cost perspective, and also provides us a little bit of protection should we see sort of ongoing difficulties in trade negotiations or a bit more of a flare up in kind of how these trade negotiations pan out. Certainly not our base case, but we do this in a way that is cost effective and does give us some protection in the event that kind of these, more worst case scenarios kind of play out or manifest themselves a little bit. Generally, we're monitoring the risk of these portfolios very closely and constantly. And, if there is a position where we don't think we're adequately going to be rewarded for the risk that we're taking, we will make an adjustment. And that's kind of what we're doing here. We want to make sure that we've got cost-effective protection in the portfolio for those kind of more tail events that could appear out of nowhere.
Okay, now final question that, I think investors are really right to ask, and it's the one that kind of is on everyone's mind, and a few of them have asked us, can we get an indication of when investments broadly will recover recent losses? And I know we've sort of said that, April's almost back to like nothing ever happened. But, what's you and the BlackRock's team in terms of that at the moment?
Yeah, I suppose to your point there, equities kind of back up to levels that we saw pre-Liberation Day, and bonds have kind of posted positive returns over that period as well. And then you kind of wrap in a little bit of the positive performance that we saw from that currency risk mitigation trade that we put in place. And generally, more conservative profiles are definitely looking positive for the April period. And really, when we think about performance relative to our reference benchmark, that's been quite strong. And also relative to peers, that it looks like it's going to be a reasonably strong month and strong period for the ASB portfolios as well. So generally kind of on a good footing as we stand at the moment.
Excellent. Oh, gosh, couldn't have asked for more. So I just wanted to wrap up with a little bit of a reference to I'm surprised that Will mentioned it from our client call, which is very, very flattering. But I just wanted to sort of call back to a point we talked about with clients just around risk and things. But I spent a fair bit of time during April reading through customer feedback and news articles on the volatility Will's talked to in April. But in particular, we received a group of questions for that client call, largely focused on what I kind of call the "what should I do" points. And they're again, with kind of like what's happened to my investments and what do I do next are the logical ones to ask. And they're all great questions to be asking regularly, to yourself, spouse, family, checking your investment, your risk tolerance, your goals, and also your outgoings, for the year ahead are always important things to focus on. So, those questions are always best directed to your wealth advisor. If you're lucky enough to have one, first and foremost, that could be, one of our team, it could be another provider, whoever you use, or the advisor you're yet to meet. Those questions are best directed to them first. But that being said, we still wanted to kind of, acknowledge this thematic and these questions around, fully cognizant of the fact that advice is personalized and this is not, advice for everyone as such. But a book I'm reading at the moment perfectly summed up the current situation with respect to risk. And it's what Will's covered on already. And that's the concept that the risk in general is unavoidable. It's just a decision on when you want it. Is it now or later? And what I mean by that is, short-term periods like we've talked about and what we've been in, April's moves up and down, that's a short-term risk. That moves the price of things. But long-term, it's things like running out of funds to provide you for the goals you want, an amount you want to leave behind, or having an income or paycheck, that replacement paycheck in retirement that can outpace inflation. So for most people, you need to accept some risk now to avoid significantly more risk down the road. And I thought that was a wonderful perspective to leave listeners with, following the April we've just had, which is, a sort of to the effect that Will was acknowledging earlier in the call. So the last question that we do to wrap up always, Will, and you've had this one before, what are you reading, watching, or listening that you could recommend to listeners?
Yeah, look, I think I've made this joke a few times, but my reading is kind of either limited to market materials that maybe a broad audience may not necessarily love as much, and or children books that I read to my young kids. And then similarly, when I think about music, I'm listening to music that's pretty heavily influenced by what my kids are into at the moment. So unless you want a review of the new Wiggles country music album, I probably won't provide you too much there. But what I have been watching, or something that I did watch recently, and generally when I do have time to do something, I watch a documentary, and I did watch a really good one recently, which was a documentary on Ned Brockman. He's a young Australian. Yep. The documentary was called Run, with 2 N's. And he basically ran across Australia in 2022 from Cottesloe Beach in Perth, WA, all the way over to Bondi Beach here in Sydney. That's something like 4,000 kilometres in 47 days.
Wow.
And he raised a whole lot of money for homelessness. The language that's embedded in that documentary can be a little bit rough at times, but it's a fascinating story of kind of social media influence, and of course kind of just pure grit of someone sort of doing something that they're passionate about. So highly recommend that one. And
I didn't necessarily have one today, other than I just would recommend, again, to reiterate the point, if you've found April hard to navigate and wondering what you should be doing something, sometimes the best thing to do is not do anything. And I would recommend not watching, listening, or reading, but talking to someone who you've got a relationship with in terms of your advisor. That is where they prove their value in times like this. So with that, we're done. Thank you so much, Will, as always, for sharing your expertise and insights on what has been an unprecedented April. It certainly helps our customers navigate these uncertain times. Go well, my friend, and we'll see you again soon.
Thank you so much, Nigel. Great to see you.
And to you who've listened in, whether that's for the first time or as an avid follower, thanks for joining us, and we hope you found this one equally valuable. So with that, we look forward to our next podcast, which won't be too far away. And until then, it's happy and safe investing, and it's bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.